everybody, and welcome to our session today, which is on PSI and the PCG 2024 D2 update, which is the latest ATO guidance on PSI and Part 4A. All right, time to introduce our superstar instructor. He is the Director of Tax Know-How with over 30 years experience in the tax profession as a tax practitioner, as well as a lecturer. So please put your emoji hands together to give a very warm welcome to Mark Morris.
Thank you, Joyce. Great to be here.
Hello, Mark. Good to have you with us.
Thanks very much, Joyce. Great to be here.
Very, very topical topic, which is why, we've got over 1,000 people joining us today.
Wow, well, that's quite an audience. So I'll try and do justice to it for you, Joyce.
Who would have known PSI and Part 4A is
so galvanising and exciting. I agree. Anyway, we'll see what we can do.
What's on the agenda?
Well, the agenda, just going forward, obviously we'll be looking at the PCG in some detail. Essentially what I was going to do was to review the purpose and scope of this draft PCG, which is 2024/D2. And I'm going to refer to it as being the guideline. Now, the guideline applies where personal services income, or PSI, is derived by a personal services entity which satisfies a personal services business test. So what does that mean? It means that the individual has derived, personal services income, or PSI. They've done it via a company or trust, and the company or trust is not subject to PSI rules because it meets one of the 4 PSB tests. Now, you'd think, well, that's great. PSI doesn't apply. Therefore, I can do what I like with a company or trust. If it's a trust, I can split income to an associate. If it's a company, I can retain funds in the company. And the presumption in the PCG is, or the guideline is that many people work from that premise. What it's trying to stress is that advisors, once you get through PSI and you've met a PSB test, need to consider the application of the general anti-avoidance provisions in Part 4A to the derivation of that PSI. In other words, you get over the PSI hurdle, you still got another one being Part 4A. Now, what the guideline does, it basically sets out guidance as to when the ATO will devote compliance or audit resources on whether they will look at a personal services entity, a company or trust, to work out whether there is a Part 4A risk where the PSI income has been generated. And to do that, they'll have regard to a variety of low risk and high risk factors, which we'll cover in depth during the session. There are also 13 examples or scenarios of low and high risk examples given in the guideline. Now, this is typical stuff from the ATO. You've either got some very obvious answers where it's low risk, and you've got some really extreme stuff where it's clearly high risk. Where the guideline lets us down a bit is in the middle ground, where things are a bit more complicated, where you may have employees, where you may need to retain funds for working capital. There's lots of unanswered questions here. But we're not looking at a detailed analysis of Part 4A. We're looking at the risk of you being picked out on an audit, or your client being picked out on an audit. So what we'll do in this session is identify some key takeouts you might want to consider going forward, and unfortunately stress that there is going to be more record keeping we're going to have to do in terms of small and micro businesses, which, running a micro business myself, I understand how demanding that can be. So the purpose...
Is this a key focus area for the ATO? I mean, is it usually when they release a PCG, does it mean that they're paying attention to it and they might ramp up audit activities?
It's a good question, Joyce. They kind of flagged that they would look at this when they released TR 22/3 a couple of years ago, because they mentioned Part 4A in that. So there's an inference that indeed they could look at that. And I guess we've had issues like, for example, now I'm seeing clients who are talking about when they had reviews or audits on allocation of professional profits and the PCG that applied there. Remember the old red, amber and green traffic light system on whether Part 4A would apply to profit allocations in professional firms? Well, that's happening. So presumably this will happen as well. But I think it's alert. One of the reasons they've issued it is to alert practitioners, hey, just because you get out of PSI doesn't mean Part 4A's gone away. That's been there forever. It's been there since the mid-'80s. It's about the time when I started, long time ago, and it hasn't gone away. They're just putting renewed emphasis on it. Yes, but there could be further audit.
Yep.
Now the draft PCG, the guideline, as I mentioned, is looking at the likelihood of the ATO applying audit or compliance resources where income has been alienated. That means transferred from an individual to a personal services entity, a PSE, being a company or a trust. And the audit risk will be based on a variety of factors, whether they're low or high risk, which we'll come to. But I need to stress at the outset, the guideline is not a public ruling. It's not binding on the tax office. Nor does it provide detailed guidance on the actual application of Part 4A. They're assuming you know how Part 4A applies and what the risks will be. It doesn't create any safe harbour for taxpayers. It expressly says it is not a safe harbour. So even if you think you're on all fours with this guideline, doesn't mean you can rely on it, which I think is really excessive. Mind you, they said the same thing, Joyce, about that PCG on allocating professional profits. And it doesn't say, well, we're going to leave you alone. In other words, you might meet the requirements of not having a Part 4A risk, but if you've got other issues that could be looked at, like Division 7A, well, they could look at those. So one of my complaints with all this is, what's the real merits of this? This is really a bit of a scare tactic, in my opinion. Now, the guideline specifically applies to an alienation arrangement where personal services income, or PSI, is derived by an individual through a personal services entity, a PSE, and that PSE is conducting a personal services business, a PSB. Now, to recap, a PSB includes where the entity satisfies the results test, or 80% of more of its PSI comes from multiple sources, and it meets either the unrelated client's employment test or business premises test. So just a brief recap on the PSI rules. The very first question to ask is, does the taxpayer receive income that is mainly a reward for their personal efforts or skills? If the answer is no, it's obviously not PSI. If the answer is yes, then the next question to ask is, does the taxpayer have a personal services business determination, a PSB determination from the ATO stating that it's not, it is a PSB and therefore the PSI rules don't apply? If the answer to that is no, and you have got PSI income and you don't have such a determination, next question to ask is the results test met? If the answer is yes, because 75% or more of PSI derived is related to achieving a certain result, then in those circumstances, you're not carrying on, you'll be carrying on a PSB test and won't have PSI. If the answer is no, and you've got 80% or more of your PSI coming from multiple sources, meaning two unassociated parties, and you meet either the unrelated clients test, the employment test, or the business premises test, then you'll have a personal services business, a PSB, and you won't be subject to PSI. Now, the alienation arrangements, assuming you get through all that apply under Part 4A, really are designed to look at scenarios where income is retained in the personal services business or income is diverted to an associate for the purpose of paying an overall lower tax rate that would have applied if the individual had returned all the PSI as income. So what does that mean? It means that Part 4A could apply where income is retained by a personal services business, which is a company. Why do you retain a company? Well, to pay tax at the lowest, at a lower corporate tax rate than the highest marginal tax rate. Or alternatively, income is diverted by a personal services business to an associate where the personal services business is a discretionary trust. So therefore, the guideline has very wide application because it could potentially apply where a corporate PSB does not fully distribute income, or a trust PSB I should say, engages in income splitting. And importantly, the guideline will apply retrospectively as well as prospectively. When doesn't it apply?
Ask, Mark, when you say alienation of arrangements, is that just a fancy way of saying, like Part 4A, like trying to stream income out of the PSI rules? Something like that?
Yeah, it's really transferring would be a good word. You're transferring income from the individual generating PSI, Joyce, to an entity like a company or trust. And why are you doing that? well, you could be doing for a number of reasons, but one of it might be either to pay a lower rate of tax or, in the case of a company, defer it.
Yep.
So that's what alienation means, I think, transfer. You're right, it is a fancy word.
It is a fancy word.
It is a fancy word.
Yep.
And
it's kind of like interchangeable, right? Like Part 4A applies to alienation of that PSI income.
Correct.
Yeah. Okay, cool.
No, it's a good pickup. Sometimes you get lost in tax land jargon, don't you? Or I do.
Yeah, it's just a new word. It's I've never heard of it before, and except in the PSI rules. I don't see it anywhere else in tax.
Yeah, essentially, you're right. That's when I've always spoken about it. Now, the guideline won't apply where the PSI rules apply. So, for example, if you don't have a PSB and you're subject to the PSI rules, that's all you have to worry about. You have to deal with the PSI rules. Nor will it apply where income is derived from the use of assets, the sale of goods, or from a business structure. So if you've got a genuine kosher business, like an accounting practice with employees and goodwill and staff, well, then that would be caught. Now, what are some issues dealing with this that as tax advisors we need to consider? The first question is to make sure the income we're looking at is actually personal services income. Because remember, we have to consider if it's PSI, the PSI rules can apply, and if they don't apply, because you're carrying on a valid personal services business test, you meet the results test, or you meet the unrelated clients test, then you have to consider Part 4A. But a precursor or threshold issue here is the income has to be PSI. Now, PSI, personal services income, is ordinary or statutory income that is mainly a reward for the personal efforts or skills of a particular individual. Now, mainly in this context means more than 50%. And this is extensively discussed in a ruling came out a couple of years ago on the meaning of PSI, being Taxation Ruling TR 22/3. But one of the things we probably need to consider in determining whether there is PSI or not is to look at the value of all the business inputs provided. And you may have multiple inputs provided in addition to the individual's labour. So, for example, they might be providing assets, they may be providing materials or goods, or they may be involving other individuals in the delivery of a service. So a plumber who comes by and you pay him a fee, but more than 50% of the fee is attributable to the parts you're purchasing from him and labour of an apprentice, well, then you'd say maybe that is not, or would not be, personal services income, because less than 50% of the fee you're paying is attributable to that person's services, which means we need to value each input and determine whether more than 50% of the total value of the service is attributable to that individual's labour or to other factors. But it just may not be PSI when we dig into it. Now, assume there is PSI, and then assume that you've got it derived by a personal services entity, a PSC, which is a company or trust. And that company or trust meets a personal services business test. You then need to determine the likely risk of Part 4A applying and the ATO conducting a review. And the guideline, as I mentioned, lists factors which will indicate low or high audit risk. Now, where you go through the 13 examples, and we'll cover about 7 of them today, you'll find that when the ATOs state that a tax benefit arises, that they'll automatically apply Part 4A. But there's no detailed discussion of the mechanics or provisions of Part 4A, especially the 8 factors that must be considered in determining whether the dominant purpose test is met, which is set out under Section 177D. And that's important because obviously the Commissioner's lost a couple of cases on Part 4A because the dominant purpose test wasn't being able to be objectively proved, which means they're working from the premise advisors must be able to understand how Part 4A applies. Now, Part 4A, as you know, is the most complicated area of the income tax law virtually. It's a minefield, but at its broader sense, you need 3 requirements for Part 4A to apply. First, you've got to ask, is there a scheme? Second, did the scheme result in a tax benefit? And third, did a person enter into the scheme for the sole or dominant purpose of obtaining a tax benefit for a taxpayer? If the answer to all 3 is yes, the Commissioner can cancel the tax benefit and in a PSI context, attribute the income back to the individual who provided the personal services if they think Part 4A applies. Let's give an example of, or discuss, Part 4A in more detail. The first is that the term scheme, which is the first element, is very broadly defined, as you probably remember, and captures most transactions. So a scheme can be in writing, it could be verbal, it could be legal enforceable, it could be unenforceable. In fact, it could involve a unilateral scheme where only one party to a transaction has a tax avoidance purpose. Then you've got to look at the concept of tax benefit. Now, following amendments made in 2013 and the Guardian decision, which was a real landmark decision in 2013, we now know that in determining whether there is a tax benefit, we need to look at what would have occurred or what might reasonably be expected to have occurred if the scheme had not been entered into. And this alternate transaction gets even worse, Joyce, the language here. The alternate postulate means you compare what actually happened with what was the most reasonable commercial alternative. And when you consider that reasonable alternative, you have regard to the tax cost of that reasonable alternative, or if you like, alternate postulate. So if you remember the Guardian case, there was a washing machine arrangement which resulted in tax being paid at the corporate tax rate. The alternate postulate was to distribute all the income automatically offshore to a non-resident beneficiary who pay tax at the top marginal rate. Well, clearly, you would ordinarily want the washing machine arrangement from a tax point of view because you pay less tax. But the alternate postulate, the court said, well, the fact it was tax disadvantageous didn't mean that wasn't an alternate postulate. What does all that mean? It means that it's pretty much easier now to have the tax benefit test met than it would have been, say, 10 years ago, following the changes to Part 4A.
So can I just ask for a PSI scenario? The alternate postulate is, instead of having a company or a trust, you could have just earned the income as a sole trader, as an individual. Something like that?
That's true, Joyce. The alternate postulate might be, let's say I divert income to my daughter, and the alternate postulate might be, well, what would you have otherwise done? Oh, you would have declared all the income to you because your daughter doesn't really work sufficiently in the business.
That's the 100A. Yeah.
Yeah, a lot of overlap with 100A. You're right. But and indeed with that washing machine arrangement, I know a different topic. I mean, you've got to take that under Division 7A, 100A and Part 4A. And what you're now seeing is audits where there's like a pincer movement where when a family group, one might have taken Division 7A on one, 100A on another and Part 4A on another. So they've got lots of tools in their armoury. And in terms of the dominant purpose test, it should be remembered that a tax avoidance purpose of a tax advisor can be imputed to a taxpayer in some circumstances. So let's apply Part 4A to where we've got a PSI scenario. So let's say we've got Alice. She's making a net profit of $100,000, which is PSI. And she does it via her family trust. And it's PSI, but she meets a PSB test because she's got unrelated clients. Let's say Alice, of $100,000, the trust distributes, or the trustee distributes $60,000 of that amount to Alice and $20,000 each to her two adult children, who of course won't pay any tax on that, essentially. The scheme would be the trustee's decision regarding the allocation of net income amongst the beneficiaries. The tax benefit, well, less overall tax is being paid because income has been split with Alice's children, whereas it would have been fully assessed to Alice if she'd received it directly. Mm-hmm. And the dominant purpose, well, that was entering the scheme to do the income splitting because it's had the effect of reducing Alice's tax liability. Now, the same Part 4A could apply to the retention of income as well. Mm-hmm. So the Commissioner could argue Part 4A could apply where income has been retained by a PSB, which is a company. And here the scheme would be the decision to retain income in the company rather than distribute it as salary, director's fees or dividends. The tax benefit obviously is the fact if it had gone to, say, the primary individual and then on the highest marginal rate, they'd pay more tax than the company, which would pay tax at a lower rate. And a sole dominant purpose test, you'd say, would be met if funds were retained for that purpose, i.e. accessing a lower tax rate by having the income retained in the company and paying tax at 25 or 30%. Now, there is a recognition in the guideline that you could retain profits if you're a company which is a PSB, where you retain those funds to, if you like, acquire a business investment in the future or business asset in the future, which will improve the efficiency of the business, provided the company, quote, seriously contemplates such an acquisition. I'm not sure what that means, Joyce. It means probably a definite commitment. So in other words, you sock money away and you're putting money aside so that you can buy a business asset next year, which you argue is going to improve the efficiency of the business. So you'd want some minutes in a director's meeting. You'd want something firmly in writing indicating a commitment to do that, in which case that could be a possible exception. But otherwise, if you retain funds in there, as we'll see later, that will raise a Part 4A risk.
Gosh.
Yeah, I tell you, it's getting hard now, game. It's getting too hard.
There's too many anti-avoidance stuff. First you got
too much anti-avoidance.
Now it's like PSI as well. Oh gosh.
Yeah, I know, and more coming. So the dominant purpose test, obviously, we're talking about the scheme and tax benefit are pretty easy thresholds to meet, which means to prevent the application of Part 4A, the trustee's dominant purpose or the taxpayer's dominant purpose in entering into a scheme must be something other than the achievement of a tax benefit. And my question would be, what would that other purpose be? So if I'm allocating income to my daughter, it's above the market value that you charge for her services. Why am I doing it if it's not for tax reasons? What's the commercial justification? And the answer really is that, sorry, I didn't mean to cut you off, Joyce.
No, you go.
The real answer, I think, is that Part 4A is very powerful because the Commissioner will apply Part 4A to a diversion of PSI away from a primary individual or the retention of net income in a PSB. And ordinarily, taxpayers will have considerable difficulty in overcoming the sole or dominant purpose test.
Yeah, it's tough because, the adult, or the parent earned the money, blood, sweat and tears.
Correct. And it's going to the kids. And why are you doing to the kids if it isn't to reduce your tax liability,
Yeah, you could have distributed it to yourself and then gifted it over. Is that what the ATO is trying to get at?
I think so. And you pay tax, and in my case, I'd pay tax at the highest marginal rate, whereas my daughter might be on the lowest marginal rate. Do you know what I mean? So I pay tax on it, and from that, I can gift some of my after-tax amount to her. But they're almost tracking, well, if you're going to income split or you're going to retain income, why are you doing it? And usually be for tax-driven reasons.
Yeah.
Almost. Please.
The difference between PSI and Part 4A, PSI and 100A, with 100A, if the money, the cash actually went to the daughter, then it's kind of still okay. But PSI is saying it's the person that actually derived the income that should be taxed on the income.
Yeah, look, that's a really good distinction about between 100A and what could happen here with Part 4A. You're quite right because, if the money actually, it's almost like 100A follows the money a bit, right? Yep. Here you're saying, well, is there a justification for diverting income? And if it, as you'll see, they're trying to tighten that up. So you're going to have very kosher reasons as to why you're allocating income. So if my daughter works, it is, And
if she didn't work there, then she shouldn't get any of the money.
Well, she's the boss anyway, which is another point. That didn't work. Yeah. But, essentially you're going to have to come with a rationale why you're doing it. And there's going to be a lot more, I think people in the tax office don't realise those in small and micro business, we don't have the same level of formality in our dealings that you would with a larger organisation, But anyway, the reality is, though, I think in essence, Part 4A is a really strong hurdle to jump. And I speak to a colleague of mine who's fantastic. He has a lot of medical practitioners he looks after. And, I think he's very much of the view that Part 4A will apply ordinarily because I can't think of a rationale to split income once you start exceeding what would be an arm's length rate for the provision of services by, your spouse if you're running a business or whatever. I should stress too, one other thing that's noticeable about this guideline, Joyce, it only applies to professionals. So it doesn't apply to tradies. Well, when I say it doesn't apply to tradies, can I actually be a bit more clear about that?
Yep.
All the examples, all 13 examples deal with engineers or IT consultants or lawyers or accountants, but never deals with tradies. So, it's just, and not to say these rules couldn't be extrapolated to tradies, and there's no equivalent comment in this PCG, unlike the one that applies to allocation of profits, which specifically says these are the professions we're applying it to. It's just interesting that none of them deal with tradies. So the CFMEU are safe, basically, but just interesting. Now, you might argue, well, can't I argue asset protection? Can't I say that I'm setting up this personal services entity for asset protection purposes, which was a successful argument in the full court case, Motchkin's case, back in 2003. Now, the ATO kind of acknowledged that you may set up a personal services entity like a company or a trusted corporate trustee for asset protection purposes. But once the PSC's set up, what the ATO is saying, we're then going to look at any diversion or retention of income after it's been set up. And we're going to call those post-creation transactions narrow schemes. And by that I mean you can no longer just say asset protection gives me a right to income split. It gives you the right to set up an entity. And in a litigious society, you'd be crazy not to have a company or a corporate trustee with a trust. But they're saying post-creation, we're going to look at whether there's a narrow scheme. And the narrow scheme will be the diversion of income or the retention of income after the entity set up. Now, it's important the Commissioner identify the correct scheme. They didn't do that in Moshkin's case because the tax benefit must result from that narrow scheme. But the Guardian case also is notable because it said, well, a scheme can be a series of steps or it could be a single step. So the decision for me, for example, in my trust to distribute part of my income to my daughter in excess of what she could charge, that would be sufficient for there to be a narrow scheme. And in which case, asset protection won't be a defence. So in the past, I remember many years ago when I went to a meeting on personal services income representing one of the professional bodies, arguing the ATO is, this is what we'll do this for asset protection. Well, they're being a bit more sophisticated here. They're actually going one step further and saying, post-creation, why are you doing what you're doing? And if you can't justify it, we'll have a go at you. Now, the low and high risk features that could potentially apply, the guideline lists an array of factors. Essentially, you'll have a low risk arrangement where the net income that's received by the individual via the PSE is assessed to the individual whose efforts generate the PSI. What do I mean by that? It means basically the PSE generates the net PSI and passes it all to the individual who produced the work. So the PSE, if you like, is a conduit. Now, there is a positive thing about the guideline, is it making the point that that income that's assessed to the individual can take the form of salary, but it can also take the form of a profit distribution by the PSB, whether it's a company or a trust, or even distributions via an interposed or intermediate entity, if there's an entity between the trust and the individual. The important point is all the net PSI has to end up with the individual, either directly, say salary, or indirectly via profit distributions. So if you've got a trust and you've got 100 grand worth of salary and at the end of the year you're going to get 50 grand profit distribution, provided that net profit distribution goes to you and not to family members, that'll be regarded as being okay. By contrast, a high risk arrangement will arise because a tax benefit has been obtained where the PSB is a trust which either diverts income to associates to pay less tax or retains income to either reduce tax or defer the payment of tax. Now, one of the throwaway lines to be aware of with the guideline is they're saying only as the ATO devote compliance resources to high-risk arrangements where the tax benefit is material. We won't do it where the tax benefit is immaterial. So that they're kind of inferring, let's say the salary for your wife when she's providing services is $80,000 and you've paid $90,000, or $85,000, we might leave you alone. The reality is, remember, this is not a safe harbour. This is just a clue of what they may look at. They're just saying, if you've got high risk factors, doesn't guarantee we're going to come down, burst the door down at 3 a.m. in the morning. It just means you might be on the, hit list later on. And therefore, I think my recommendation would be pretty scrupulous, particularly when you've got things like payments to associates. Have timesheets, pain in the neck, I know, for time spent by associates. Have an hourly rate, like an award rate or a rate that may be charged by a labour hire firm. So it's not, it appears reasonably, defensible. Now, low-risk indicators that you don't have a problem would be where the net PSI, after you take into account valid expenses, is distributed to the individual generating the PSI and is taxed at their marginal tax rate. Also low risk if the remuneration that individual receives is commensurate or proportional to the value of the services they provide, and it'll be low risk if remuneration paid to an associate, let's say a spouse or a service trust, for genuine bona fide services they provide is calculated on a reasonable commercial basis, e.g. award rate. Be low risk if the timing difference between the earning of the PSI and its net distribution is outside the control of the individual or the PSB and it's temporary. There's an example in there where the individual who owns a company usually gets paid a bonus at year end to clear out the profits. He gets ill one year and the bonus is subsequently paid at the beginning of the next year. Ordinarily he's fully compliant and flushes out all the income. In that case, they'll probably leave you alone. The PSB, if it makes a superannuation contribution on behalf of the individual employee rather than pay salary, that's kosher. So in other words, if another example, individual employee has an 80 grand package, they decide to take 30,000 as super, 50 as salary, that's okay. You can split it, provided you're not exceeding your cap on concessional contributions. And if you've got a temporary retention of profits to acquire an asset by a company in the future for a commercial purpose, that could be potentially low risk if you can prove you've got a definite commitment to it and you actually do it. But you can't, if you like, sock away funds under this guideline for, say, working capital, which I think a lot of people would prudently do in a lot of cases.
Yeah.
But
I have a big problem with this particular one.
I do too, yeah. I think it's the biggest problem with it, Joyce.
Because it's your company, it's your profits. You can do what you want with it. You want to park it in a company, then why not?
And, I understand the logic. I think their worry is that it stays in the company, it pays lower tax, and they actually give an example where it might come out later as a Division 7A loan, but they're still saying deferrals of tax are enough to have a problem. We may disagree with it, and what we really need, I think, is for cases like this to be litigated. We need the ATO and to run cases, test cases, so we have certainty. They're not doing that at the moment. So that's a bit of a problem.
Interesting.
High-risk indicators, the net PSI is distributed to another entity like a spouse or family member to lower the overall tax liability of the family compared if all the income had gone to the principal person and they would have paid tax at the highest marginal rate. Another high-risk indicator, the remuneration received by an individual is not commensurate with the services they provide, or the PSB does not distribute income to the individual providing services. That's a real issue. So if you've got a trust, which is a PSB, and it's all being allocated to other family members, well, that's a red flag. If the net PSI is fully or partly split with an associate to reduce overall tax liability compared to what would have been payable if the individual had been fully assessed, that would be a high risk factor. Remuneration paid to an associate, which is not commensurate, I think let's say excessive would be a good word, for this compared to the services they provide, that would be a trigger. And if the net PSI is fully or partly retained in a PSB, which is a company, again, red flag. Why are you doing it? And I agree with you, Joyce. For those of us who run a business and take a punt that's involved with that, you'd almost argue that that's a bit unfair. But nonetheless, come back to Part 4A. If the reason you're doing it is to get a tax saving or a tax deferral, then you've got a Part 4A risk.
Yep. But it's just saying that Part 4A could apply.
Yeah. And that's a very important point about this guideline that you've kind of highlighted, Joyce, in the sense they're just saying these are factors about when we will look at you. Doesn't mean you're going to go, but, these are things, the famous swimming between the flags kind of concept that, has been put out to the ATO for some years, that really addresses that kind of concept. Now, some sample case studies, and we'll work through these together, and just indicating how the regime works. The first example deals with an engineer. So there's no tradies. There's no tradies. And
I think tradies have such a bad rap, so maybe the ATO doesn't want to
mess with them. You don't mess with them. Anyway, you've got, in this case, an engineer, Alan, who's an employee of a company she set up called EBEC Proprietary Limited. Now, EBEC Proprietary Limited contract to provide Alan's services to various unrelated parties. It's PSI because it's Alan's personal services, but income. But you meet the PSB test being the unrelated clients test. Now, in her case, or the company's case, what they do with the funds is that they pay all the operating costs, which you can see at the bottom. They pay a salary to an administrative assistant, Hooper, who's not related to Alan, at a market rate. And the balance of the netting PSI is distributed as salary and superannuation to Alan. So at the end of the day, all the PSI, net PSI, will ultimately go to Alan after you pay valid expenses. And of course, you'd want to benchmark, for example, Hooper's salary with some kind of award rate. Do you think that is high risk or low risk?
Oh, yeah. Let's ask the audience. What do you think? Is this example high risk or low risk? Considering that Mark has just gone through all the factors just now. Yay! We can see a lot of lows. Everybody's got it right. I think 100%.
Yeah. What else would you expect from the tax nuggets community, really?
Yeah.
We're absolutely right, guys. It's low risk because, hey, all the income's going out to Alan, all the net PSI income. The next one is a really bit of a strange legacy kind of example. So what it deals with is a discretionary trust, which we'll call the Kika Discretionary Trust. And it has three principals, Adam, Olivia, and Yang, who collectively control the corporate trustee. Now, they earn differential amount of fees, but both Adam and Olivia and Yang, via the trust, contract with unrelated parties. What's interesting about the example is they don't work on each other's clients. So let's say Adam's got 2 clients, Olivia's got 6 clients, and Yang's got 1 client. You'd think in a real world scenario they'd work on each other's clients. This example seems to presume work on the premise that there's a single consultant for each kind of category of client. There's no crossover. They're not working on each other's clients. Let's also work on the premise the trust has no substantial assets and no employees. Now, what you have to do from the PSI rules is you have to apply the PSI and PSB rules to Adam, Olivia, and Yang. So Adam, Olivia, and Yang all get fees paid during the year. Adam gets 80,000 of his 250,000 fees. Olivia 300,000 of her 750,000 fees, and Yang gets 50,000. Now, from a PSI point of view, Adam and Olivia have multiple clients, therefore, which are not associated with each other. Therefore, they meet the unrelated clients test. So they meet a PSB test. So they don't have a problem with PSI. Now, let's assume the balance of their income after the fees have been paid of 80 grand and 300,000, the balance of their fees earned is distributed by year end. Adam and Olivia, will not have an issue. But Yang, on the flip side, he has only 1 client. Therefore, he can't meet the unrelated clients test. Therefore, the PSB test will not be met. In which case, he'll have $150,000 treated as PSI, which the trustee has been treating as a payment which is subject to PAYG withholding tax. Do you think that's a low risk or high risk scenario?
So in respect of Adam,
Olivia, and Yang.
Yep.
Are any of them high risk?
Let us know what you think, people. Are any of them? Yeah. Anyone? So, like, risk of whether Part 4A applies, yeah?
Correct.
Oh, we got very mixed
Ah,
I think a lot of people are saying it's high. Definitely for Yang, it's a high risk, and low for the rest.
well, actually, I think it's low risk. And the
Mm.
argument I've got is that, well, with Adam and Olivia, they don't have PSI because they met the PSB test, and their share of income gets paid out to them by year end. So they won't have a Part 4A risk because the income that they've derived is going out to them. Yang, on the other hand, with the trustee has complied with the PSI rules, hasn't had to look at Part 4A because it applied with the PSI rules. Now, if the trustee had not withheld tax from the PSI that's been derived by Yang, then that would be a high risk. Remember, you got PSI in an entity, the trustee needs to withhold tax and treat it like, it's akin to a salary payment. You're required to do that under the Tax Administration Act. So it's a bit tricky, scenario, but I would regard as low risk. I'd also regard as unreal because ordinarily Adam, Olivia and Yang would be working together and helping each other out,
Yeah.
But apparently when PSI was first mooted or considered, people were structuring like this, which is why I think they put the example in the materials. The next example 6, deals with Hayley, who's a medical specialist, and she's an employee of her company, Hayley Medical Proprietary Limited. Now, Hayley Medical Proprietary Limited contract to provide Hayley's services to a range of unrelated parties and meets the PSB test, obviously, because there's unrelated clients, and usually derives profit of $250,000. Now, and Hayley, importantly, is the only employee, which is also a bit unreal. There's no support staff, there's no nurse, there's no medical equipment. This is where, you wonder what world people live in. But anyway, let's say in the past, all the $250,000 in net profit, net PSI, has been distributed to Hayley either as salary and or bonus. But in the 2023 year, and I should stress, I've used that because that's the year cited in the guideline. Let's say in that year, Hayley only gets salary and bonus of $243,000 because there's a definite commitment to use $7,000 of funds set aside to buy a new customer relationship management software. And that's a firm commitment. Is quote, seriously contemplated, whatever the hell that means, but I would call definite commitment. So in that case, they're saying, $7,000 has been put aside. Let's say the asset's purchased in August of the next financial year, August 2023, for $5,000. Turns out to be less than the $7,000 retained, and then they pay the $2,000 bonus, that's excess, if you like, in the 2024 year. Do you regard that as high risk or low risk?
Yep. We've got people all saying low risk, which is everybody's been paying attention.
Wow, that's great. Okay. I think it is low risk. Then the question is, and for that's why I think it's probably a very useful example for people to hone in on, Joyce, because, what if it was $70,000? And what is a seriously contemplated purchase? Do you know what I mean? So I think practically speaking, if you're going to do something like that, it has to be an asset that's used by the business. It's going to result in the efficiencies in the business, and you'll need documentation to prove that it was a very kosher commitment to do, rather than like a provision. Do you know what I mean? Because if it's a provision and it isn't, just being setting aside funds, then that could be attacked by the ATO. Next example deals with Kelly, who's an insurance broker who set up a family trust because legal action was instituted against her whilst operating as a sole trader. So she set up the trust for asset protection purposes. Now she contracts, or rather the trust contracts her services with various unrelated parties, which means that, and assume as you would with a broker, no substantial assets, no employees. Because there's unrelated parties, the trust will have PSI income, but because of those unrelated parties will meet a PSB test. So let's say the trust then distributes 50% of the net PSI to Kelly and 50% of the net PSI to Kelly's family trust, which consists of Kelly and her 2 adult children. So, there's a major trust running trading, trading in Kelly's services.
but 50% of that distribution goes to a separate family trust consisting of Kelly and 2 adult children. Low risk or high risk? What do you think?
Do the kids work in the... Yeah, that's
Really intelligent question. Go to the top of yeah, wonderful question. Yeah, well, that's a really salient point. If they are, maybe that justifies the distribution.
Yep.
Well, you'd probably want to have some evidence that they are, though, and on what basis, but it's a really good point.
I think 99% of people said high risk, with one person saying medium risk.
We should have medium risk. Where's Amber? Where's Amber in all this? Where's Amber? We need Amber.
That's the grey area, the grey zone, the no man's land zone.
Well, subject to Joyce's really intelligent comment, because that would change the answer. The ATO's view is, let's assume the kids aren't working in the business. Well, you're paying less overall tax than if it all gone to Kelly by distributing money to her adult kids, which you'd think, in the scheme of things, if they're on a lower rate, would result in less tax paid. So they're calling it high risk. But I think Joyce has just highlighted some of the limitations of the examples in the guideline. The next example deals with Chester, a lawyer. See, no tradies, who provides his legal, sorry, it's a bit of a bugbear of mine. Chester contracts his legal services directly to companies X, Y, and Z for fees of $400,000 per annum. And then in the 2023 year, Chester decides he'll set up his own company. And the company contracts directly to provide Chester's services to companies X, Y, and Z. Chester's the only individual working for the company, so obviously he's deriving personal services income, but you've got 3 unrelated companies there, therefore the PSB test is met. Let's say in 2023, the company distributes $20,000 to Chester, let's say as a salary, and the balance of $380,000 is left in the company, is subsequently made available to Chester as a Division 7A loan. Do you think that's low risk or high risk?
Let us know what you think. For example, 8, low risk or high risk. Majority saying high, but we've got a couple of lows in there as well.
Yeah, well, look, it's a good point, because it is high, because they're saying, well, why are you doing what you're doing? And basically, by having the income in the company, you're paying a lower rate of tax and you're getting a tax deferral. So I think those who've thought low, I can understand why they would, because it is a challenge to paradigms or thought for preconceptions a lot of people would have had, but they're regarding it as high risk, which means the inference is you need to flush all the funds out where it's PSI, unless you can come with a compelling reason why you're retaining it.
Yep.
Example 10 deals with Terry, who's an engineer. He sets up a trust, being the Terry Trust. The trust contracts to provide his services to an unrelated parties. The trust has no substantial assets, no employees, and indeed engages Terry to provide those services under a verbal agreement for which he doesn't get remuneration. Trust then makes the income, that Terry's net PSI income, and distributes it, or has the option of distributing it to Terry or his family company or a family unit trust. Let's say in the 2023 year, it decides to distribute the trust, the net PSI income to the unit trust, because the unit trust has got tax losses in it. Okay. Is that high or low risk?
Your response is coming, people, and thanks for being so responsive. Yeah,
I'm very impressed.
100% of people said high risk.
100%.
Where's the siren?
Well, yeah, absolutely. Well, that's a great outcome. Well, it's true. It is all high risk, isn't it? In the sense that if it had gone to Terry, he would have paid tax at the highest marginal rate, potentially. The final example deals with Tom, who's an engineer. He provides engineering services to his company, BLD, and he doesn't get any salary for doing it. Now, in BLD, it has 2 arms to it. There's the engineering services that Tom provides, but in that part of the business, there's no substantial assets, no employees. But he's got multiple clients, so he meets the PSB test. But the company also has another arm in it where it trades and buys and sells goods, It has some employees working in that business, but it's a loss-making activity. So what it means is that where profits arrive, being the net PSI from Tom's engineering services, they in practice are being offset against the losses in the company. Now, is that transaction high or low risk? Wes?
That is not what you think, people. Hi. Everybody's saying hi, except one person who said it's low.
Well, it's interesting. Well, the ATA view is that it would be high. Essentially, the profits that are otherwise being assessed to Tom as PSI income isn't. He's not getting paid any salary, and there won't be any profits to pay dividends. What's happening is the income in question is being absorbed with losses. So therefore, it's high risk. So what are some key takeouts from the guideline? Well, in terms of record keeping, whilst the guideline is saying we recognise with family businesses, everything's done a bit more informally, and then they just ignore that and say, we expect you as a personal services entity to contemporaneously document all transactions. So as you go, as you work in your business, you need to be able to document various things. So some of the non-exhaustive list of some of the things they're looking at. Well, they expect to see contracts between the personal services entity and the primary individual. They'll also expect to see contracts where that individual services are provided to clients. So when you haven't got things documented, that's one probably significant issue. They'll probably look to see timesheets or diary notes of work performed, particularly when you've got associates performing work. They want bank statements and loan documents, not entirely sure, but they'll want to see financial accounts, general ledgers and tax returns to see what income is being returned, for example. So one of the positives of the guideline is saying that income can be in the form of salary, but also profit distributions. So the ATO would probably want to check that. They'll look at wage and superannuation records. You want to, have some basis on which you're charging wages, particularly to associates. They want to look at trustee resolutions, minutes of directors' meetings could be really important if you're deciding to retain income, if you can come up with a valid reason. As I said, that can be challenging, as well as other records explaining transactions such as emails and spreadsheets. So what are some of the takeouts? The first thing, remember, would go back to fundamentals. Is a particular income PSI, personal services income? Remember, it's not PSI, and you don't have to worry about the PSI rules or Part 4A if the income is arising from the principally or mainly from the use of assets, sale of goods, or carrying on of a business. Where you've got multiple inputs provided, it could be that people are engaging the relevant entity for more than 50% of those non-labour components, e.g. more than 50% of the services for their provision of materials or goods or the use of assets or the services of other personnel. Remember, if Haley was caught with under 6, the medical practitioner, because she was the only employee, what if she had a senior nurse performing high-level services? Would it have been different? If she had medical equipment that she needed to use, would it be different? Yang was caught with, under the PSI rules, he would have had a PSB exemption if he had served some of the clients of Adam and Olivia. The next thing to ask is, what is the net income of the PSB, and are there any circumstances that would justify the distribution of less than 100% of the net PSI to the individual? Clearly, when you're diverting income, you're looking at for a commercial reason why you're diverting income. If you're only doing it for tax reasons, you can't. You're going to have to distribute it to the relevant beneficiary. Where income is retained by a PSB that's a company, you're going to have to prove that funds have been set aside for a business purpose. Have a look at that example 6. It kind of illustrates that concept. But you will need evidence to justify any such retention of funds. And what that probably means in practice, what the ATO is envisaging, Joyce, is we're going to sit down with our clients, look at their management accounts before year end, and we're going to work out, we're going to buy a new software product next year. We're going to buy a new truck and have a definite kind of commitment to it, have it documented. The reality is for smaller micro businesses, often you don't see them that often. You may not always see them before year end. So from a practical point of view, I'm not sure that's a real goer, but that's one thing you might want to explore. When you've got services provided by an associate, important that they fill in timesheets as they work, so you can contemporaneously document the hours worked via timesheets, and also have a commercial hourly rate that's acceptable, whether it's an award rate or a labour hire firm rate. And importantly here too, I'd always have the payment in the form of remuneration, like salary, not a profit share, because essentially that would prove really, you've got to remember, be able to justify the arm's length nature of the payment you're making. And finally, asset protection is not a sufficient defence under this guideline. You cannot rely on asset protection after you've set up the PSE and later on you've got a company or trust and you're either diverting or retaining PSI. The ATO will argue that narrower scheme applies under Part 4A, and really there's little chance of mounting a successful defence where less than 100% of net PSI is ultimately distributed to the individual. Essentially, if they want to go hardball under Part 4A, remember, you're guilty until proven innocent. You've got to prove a reason why that should not occur. And as we saw before, Part 4A with scheme, tax benefit, and even dominant purpose in the context of PSI are relatively easy thresholds for them to meet. And with that, I'll pass back to you, Joyce.
Let's start off with the first one about, is it PSI? So there are some questions today about, business structure, or is it use of an asset? So would you say like a piano teacher could be considered use of an asset?
Look,
at all?
That's a really good question. I think probably that you've look, that's a really good question, and a good example of it.
Yep.
I think ordinarily the guideline doesn't really talk a lot about carrying on a business. I think you're looking at ordinarily in their mind, some critical mass when you're carrying on a business. So having multiple employees, having multiple assets. Piano teacher's a good example because I suppose people will be coming to the person for their lessons and they'll be using the assets. So you've got an argument there. As opposed to an IT person who might just rock up somewhere, do you know what I mean, with no assets.
You might have an argument, but I'd still
have an
say
argument, but I still think it's PSI.
Yeah.
But it's good lateral thinking, whoever's coming up.
As compared to, say, a truck driver who has their own truck.
So
it's more use of asset,
So if you go back to TR 22/3, which is a good ruling to read, they actually give an example of a truck which is configured in a particular way. So, if you've got a truck which is configured to do deliveries to supermarkets, got freezing in it or whatever, the fact there's a driver in it is almost incidental. You're really doing it for freight. So that would be, and typically if you're going to do that, you're going to have a business structure, you're going to have multiple clients, you're going to have probably other people involved. But yeah, in those circumstances, the use of assets would be significant. And probably good to look at that ruling too, Joyce, TR 22/3, when lots of examples in it. There's 40 examples in it, lots of real life stuff people can potentially harvest.
Yeah. So TR 22/3. Next question is from Bradley. Is it worth getting a PSB determination? And what if it's not in your favor? I guess, it's really the same as a private ruling in a way.
Yeah, it's kind of akin, isn't it? Someone asked me what's the difference, and I guess that you can go both options. Most people get a PSB determination. PSB determination might be something you go for where normally you meet the unrelated clients test, but exceptional circumstances have arisen where you couldn't meet it this year. You've done it in the past, you'll do it in the future. Or you met the business premises test in the past, you've had a flood, you've had to move in with someone else for 6 months, you're going to go back to your own office later, and argue that. That's the kind of thing PSB determinations I think are used for. Certainly worth trying it, because if you do and you get a PSB, the PSI rules don't apply. But remember, you still then got to consider, and in fact, you've always had to consider, but now the ATO underlining it, you then need to consider the application of Part 4A.
Yep. And I think you did mention one time about spouses. So,
yes,
can a PSB, still distribute income to a spouse?
Yeah, I believe they
low
can.
risk.
I believe that they can, Jules. I think the difficulty now is, particularly if you run a micro business, you're going to have to document, well, what does the spouse do? What hours do they work? And what am I paying them? Do you know what I mean? And is there a basis for paying them?
Yep.
So when so if you've got someone working for you and they're doing graduate work, you probably look at what would a graduate account earn in a, small suburban practice, and use that as your benchmark if your spouse is doing that or your child is doing that. But certainly a spouse can work in the business. The difference is, I think they'll seize on it. If they see 80 grand coming out to the spouse, but really they only provided, say, when they analyse it, 20 grand worth of time, then they'll have a go at the 60 grand difference.
Yeah. You still have to be able to justify
the
income that's distributed to the spouse.
And even having contracts like you are engaged to provide services rather than have something ad hoc and informal. The reality is in the micro business world, people don't do that, or small business. They're trying to survive,
Assistant Nugget, could you go to example 3, please? In the case study.
Do you want me to do that? Or
no. I'm good.
Oh, my goodness. This is very, very unfortunate.
Thank you. With Adam and Olivia, would they, do they still need to pay the remaining profit to themselves? I guess
yes.
The question. Yeah, for it to be low risk, yeah?
Correct. So let's say they get salary of 80 grand, Adam gets salary of 80 grand, he's got 250,000 net PSI attributed to him. That $170,000 balance in net income would have to come out to Adam. Now that might come out, when they do the trust return and everything else, but at the end of the day, if the 250,000 comes out, whether it's fees paid as a salary of 80,000 or it's 170,000 balance of net income as, I say, a trust distribution, then that's fine. The key thing is it comes out to him and is returned by him.
Yeah.
And that's obviously working on the basis that net PSI is, after you take into account legit expenses like rent and all those kind of things, is $250,000. So yes.
Okay. Can we go to example 6, please? Haley in the medical practice. Adam has asked, instead of paying a salary to Haley, is an unfranked dividend an option? Does it increase or decrease the risk there?
That's a really good question. I think one of the things that coming out of the guideline is they're just saying we want all the net PSI coming out ultimately the individual, whether it could be salary or by way of dividend. As long as it ends up, in this case, in Haley's tax return, it doesn't all have to be paid as salary. Some of it could be in the form of dividends or director's fees or bonus. As long as it ends up in her tax return, that's sufficient.
Yep, understand. And then can we go to example 8? I just want to contrast that a little bit. Example 8, Greg has asked, in this example,
Chester.
Yep, the one with the Div 7A loan.
Yes.
So if frank dividends are paid out every year to meet the minimum yearly repayments, isn't that low risk then?
No,
right?
That's a really good point that Adam and you are raising, Joyce. And it's probably one of the more contentious aspects that's coming out of it is they're saying all the income needs to come out. And I think what they're really concerned about is any deferral of tax. So if you've got any deferral of tax, they've got a problem. And the only exception to that is, and that could include where, in this case, you're paying a lower amount of tax in the 2023 year because let's say the company's paying tax at 25%, then Chester on 47% or, so essentially, I think, the fact that funds have been retained and they're lent out, their view is that triggers it, and there's not a rationale for getting that tax deferral on the company. Totally get where Adam's coming from, and I think it's one of the more subtle parts of the guideline. I suspect that's going to catch some people by surprise.
Example 13, please. This one is with the losses. So Bradley has asked, so if you have an entity with tax losses and you decide to pivot and earn income to recover the losses, and the company passes the same, business test or, ownership tests, surely that operates before PSI?
Well, remember what overrides PSI here is Part 4A. So what they're saying is, why are you distributing the profits? For example, in this case, Tom doesn't get any salary, doesn't get any dividends. Why are you doing this? And the ATO's view is, from a Part 4A perspective, the income is being generated in the company BLD, so you can reduce it to nil because the company's also got tax losses from another business activity. So yes, you could meet the quantity of ownership test if Tom continues owning it, but that provisions of Part 4A could override it. They'd say it's high risk because what would normally happen our start point is Tom would have earned the income, the net PSI, instead it's gone to a company and you end up paying no tax because essentially it's been sheltered by losses. And that's the view they got. So the scheme would be the decision to divert income to the company. The tax benefit is the recoupment of the losses in the company, and the dominant purpose. Why are you doing it? Tax. Why else would you be doing it? Usually people don't work for nothing.
Mm-hmm. I'm going to take one last question, but before we do that, we have launched another poll, which is, let us know where you first heard about us. That would be very, very useful information for us. Thank you very much. So last question, I've picked kind of a philosophical one.
Oh, goodness.
Just to get your comments on this. It's like, all these PSI rules, and it kind of makes sense, personal income. But then if a business was selling widgets, the PSI rules don't apply and profits can be distributed to whomever, right? I mean, subject to other any avoidance. But yeah, this is a major inconsistency. Why personal services income is so picked on, I guess.
It's a really good point. I think if you're carrying on a valid business, and you've got multiple staff, multiple employees, multiple clients, multiple assets, you're right, you don't have the same constraints. I think we are being somewhat
picked on.
In the same way, and someone should actually litigate this. In the same way that if the ATO come up with a PCG saying, well, you've got to distribute a certain amount of profit to yourself, you've got to pay a certain amount of tax, where's that coming from? Not coming from case law, it's coming from their opinion. So I think probably my big hope for the future of the tax system is the ATO issue more rulings and we have more cases to clarify this mess, because in the interim we've got to navigate through this. And it's certainly not an easy gig being a tax advisor these days.
Okay.
But anyway,
I find it very hard that line between a PSI. When do you flip into a business structure? That's, I think, probably the
philosophical question you raise is really intelligent, because this guideline doesn't deal with the grey areas enough. It doesn't deal with more complicated structures where you've got employees, where you've got multiple assets, where you're veering towards a business. They're just trying to, frankly, I think, put the wind up people and point out that we have this view. And if you are a sole practitioner and you're buying a trust or a company, we're putting you on notice. This is what we expect. And in my experience, most people want to kind of keep the tax office at bay.
For sure. All right. That's all the time we have left. Mark, maybe one final comment. If we were to remember one thing from today's session, what would that be?
Oh, look, really work on the basis that with Part 4A that the ATO are serious about this. I think it's a game changer. I think it means that you need to document down all your relationships with your staff, with your clients, which you may not have done in the past, and be very careful, particularly in terms of companies. We all thought this would apply to trusts and diverting income to associates, but that retention net income by a company was a bit of a, sleeper issue.
Shock to be.
Yeah. And that's one really to take out of it.
Wonderful. Well, yeah, what I heard is, protect your ass.
Yeah, mate, that should be the slogan on everything we do.
Yep.
Absolutely.
Fantastic. Thank you so much for your time today, Mark. And thank you, everybody, for joining us and being such an amazing and responsive audience. Hopefully, we'll see you in our next live session. Come along to the Horsing Around one in November. All right. Thanks so much, everybody.
Everyone. Bye.
Bye.